It starts like any other day. You leave for work. Halfway there, your car makes a sound it's never made before. And then, it just stops. Or maybe it's not your car. Maybe you wake up with a toothache that's gotten worse overnight. The kind you know can't wait until next month. Maybe your phone rings, and it's your manager using the word layoffs. Maybe your washing machine floods the kitchen floor. Maybe a family member needs you on a plane tonight. None of these moments send a warning first. They don't check your calendar. They don't wait until payday. They just happen, usually on the day you least expect it. And here's the part almost nobody talks about. It's rarely the emergency itself that causes the real damage. It's what happens after it, the part where you realize you weren't ready for it. Because here's how it usually plays out. One unexpected bill goes on a credit card. That balance starts collecting interest. The interest quietly increases your monthly payment. That higher payment eats into next month's budget, and suddenly, one bad afternoon has turned into a financial situation that follows you for a year, sometimes longer. Here's the uncomfortable truth behind all of it. This has almost nothing to do with how much money you earn. Someone earning a modest income, who's prepared, can absorb a shock and keep moving forward with barely a pause. Someone earning six figures, with nothing set aside, can be one bad month away from real financial trouble. Income creates opportunity. Preparation creates security. And mixing those two up is one of the most expensive mistakes in personal finance, because a bigger paycheck doesn't protect you from a broken transmission or a hospital bill. Only preparation does. There's a simple habit that fixes this. It's not exciting. It won't impress your friends. Nobody's posting about it on social media. But it might be the single most important financial decision you ever make. It's called an emergency fund. Think of it as a financial shock absorber. A car's suspension doesn't make the road smooth. The potholes are still there. What it does is stop those potholes from destroying the car. That's exactly what an emergency fund does for your finances. The unexpected still happens, but instead of a crisis, it becomes something you can simply handle. What it's actually for. Here's what most people don't realize. An emergency fund isn't just extra savings sitting in the bank. It has one specific job, and only one job, to protect you the moment life becomes unpredictable. It's not for a holiday. It's not for the newest phone the day it launches. It's not for a sale that's too good to pass up. And it's definitely not for the impulse purchase that follows a stressful week at work, even though in the moment, that can feel like exactly what you deserve. So what actually qualifies? A real emergency is something unexpected, something necessary, and something connected to your health, your safety, your income, or your ability to keep your life functioning normally. A burst pipe flooding your bathroom at 2 a.m., a vet bill after your dog swallows something it shouldn't have, a furnace that dies in the middle of winter, a diagnosis that requires immediate treatment. These aren't lifestyle choices. They're situations that demand a response, whether you're financially ready or not. That distinction matters more than people realize, because the moment you stop treating this account like spare spending money, it transforms into something far more valuable. Peace of mind. Not the kind of peace of mind that comes from pretending bad things won't happen. The kind that comes from knowing that if they do, you're already prepared. If you're new here, I'm John. And on this channel, we break down personal finance, investing, and the money habits that actually build financial freedom, without confusing jargon or overcomplicated advice. If that sounds useful to you, subscribe and stick around, because this is only the beginning of what we're covering today. How much is actually enough? Now here's the question almost everyone asks eventually. How much money should actually be sitting in this account? You've probably heard the advice, 3 months of expenses, 6 months. Some people even insist on a full year. So which one is correct? Here's the honest answer. None of them, universally. And that surprises people, because we're used to wanting a single clean number. The right amount depends on your situation. Someone with a stable government job and no dependents has a very different risk profile than someone who's self-employed with 3 kids and irregular income. Someone with strong health insurance and someone without it are not preparing for the same risks. Comparing your emergency fund to your coworkers, or to a number you saw in a video, this one included, isn't actually useful because your circumstances aren't identical to theirs. That sounds reasonable until you realize what it actually causes for a lot of people. Chasing a perfect number is one of the biggest reasons people never start saving at all. They think, I'll begin once I can save a large amount, and that mindset can delay them for years, sometimes permanently. So let's answer the question a lot of you are already thinking. What if I can only save a little? That's not failure. That's the starting line. Financial security isn't built through one giant deposit. It's built through small, repeated actions that compound over time. Saving enough to cover even one likely emergency, a car repair, a dental bill, is a genuine milestone worth acknowledging. From there, your next goal becomes covering a few months of essential expenses, not lifestyle spending. Essentials, housing, food, transportation, utilities, insurance. If your income stopped tomorrow, this is the money that keeps your life running while you figure out your next move. And if you're already dealing with debt, you're not disqualified from starting. Many financial educators recommend building a small starter cushion, enough to cover one unexpected expense, even while you're paying down debt. That way, the next surprise doesn't force you to borrow even more. Where should you keep it? That brings us to a question that sounds simple but trips up more people than you'd expect. Where should this money actually live? The answer is somewhere accessible enough to reach quickly in a real emergency, but not so accessible that you're tempted to dip into it every time you want something. For most people, that means a separate savings account used for nothing else, not the account linked to your everyday debit card, a different one slightly out of sight, so it's there when you genuinely need it and forgettable the rest of the time. Here's where a common and expensive mistake creeps in. Some people try to make this money work harder by investing it. It sounds logical on the surface. Why let cash sit there earning very little when it could be growing in the stock market instead? Here's why that becomes a problem. Imagine losing your job during a market downturn, a situation that happens more often than people assume, because economic downturns and layoffs frequently arrive together. If your emergency fund is invested, you may be forced to sell those investments at a loss at the exact moment they've dropped in value just to cover rent and groceries. That's not a small setback. Selling investments during a downturn can permanently reduce your long-term wealth because you lose the ability to recover once the market rebounds, which historically it does, but only for money that was still invested. Your emergency fund isn't there to grow. It's there to be stable, boring, and ready. Its entire value comes from the fact that it won't lose value the moment you need it most. How to actually start. So how do you build this practically? Not by waiting for a raise, not by waiting for the right month, not by creating the perfect budget spreadsheet first. You start with a small automatic transfer on payday, treated exactly like a bill you're not allowed to skip. Here's why automation works so well, psychologically. When saving depends on willpower, remembering to transfer money manually, resisting the urge to spend it first. Most people lose that battle most months, not because they're careless, but because willpower is unreliable by design. Automation removes the decision entirely. The money moves before you see it, before you're tempted, before I'll do it later becomes I forgot. This is why consistency matters more than motivation. Motivation fades. A system doesn't, and starting small isn't something to be embarrassed about. $10 a week is 52 deposits a year, building a habit that compounds in a way that has nothing to do with interest rates. It compounds through consistency. The goal in month 1 isn't a fully funded emergency account. The goal is simply proving to yourself that you can do this. That single proof matters more than the dollar amount. An emergency fund isn't built in one deposit. It's built quietly, one transfer at a time, often while nobody's watching, including sometimes you. And then one day, life throws something unexpected at you. Because eventually it does. That's not pessimism. That's just how life works for everyone. But this time, something's different. You're not scrambling. You're not opening a credit card application at 11 p.m. with your hands shaking. You're not lying awake calculating how you'll cover both the emergency and next month's rent. You're simply opening an account you built for exactly this moment and handling it. That's the real purpose of an emergency fund. It was never really about the money sitting in that account. It's about protecting your choices when life gets unpredictable. It's about staying out of unnecessary debt. It's about lowering the quiet, constant stress that comes from feeling one bad week away from disaster. And most of all, it's about confidence. Not the confidence that bad days won't come, but the confidence that when they do, you'll already be ready. Start today. Even small, especially small. Your future self is the one who'll thank you for it.